America just lost 46 million cattle in just 75 years, and what's happening right now in the ranching industry has created a financial windfall for some and a price crisis for everyone else. On January 30th, 2026, the United States Department of Agriculture released a report that sent shockwaves through the cattle industry and grocery stores across the nation. For the first time since 1951, the American beef herd has shrunk to a historic low. As of January 1st, 2026, there are now only 86.2 million head of cattle and calves on U.S. farms. That's not just a decline, that's a collapse. In just 75 years, America has lost nearly 46 million cattle. To put that in perspective, in 1975, when the herd peaked, there were 132 million head of cattle grazing across American pastures. Today, that number has been cut by more than a third. The decline didn't happen overnight. This is the result of a perfect storm, a convergence of environmental catastrophe, economic pressure, and market forces that have been building for years. But what makes this moment truly significant is not just the numbers themselves, but what they mean for your wallet, for ranchers, for massive corporate meat processors, and for the future of American beef. Let's start with the environmental crisis that triggered this cascade. For nearly a decade, the American West and Great Plains have been gripped by one of the most severe droughts in recorded history. This isn't a temporary dry spell. Year after year, the rain hasn't come. Grasslands that have sustained cattle for generations have turned to dust. Water sources have dried up. The landscape that ranchers depend on has become a wasteland. When grass disappears and water runs dry, cattle cannot survive. There's no way around this basic biological reality. Ranchers faced an impossible choice: invest massive amounts of money to buy supplemental hay and feed their animals, or sell them off. For many, that choice was made for them. The cost of supplemental hay skyrocketed as drought spread across the region. A single bale of hay that might have cost $30 5 years ago now costs substantially more. When you're managing hundreds or thousands of head of cattle, those costs compound exponentially. A rancher with a 1,000-head operation could be spending hundreds of thousands of dollars just to keep their animals alive through a single winter. That's not sustainable, especially when the drought keeps returning year after year after year. But the drought alone doesn't explain the full story. On top of the environmental crisis, ranchers have been hit with soaring production costs across every aspect of their operation. Feed prices have climbed, fuel costs have risen, equipment maintenance has become more expensive, labor costs have increased, interest rates, which are crucial for ranching operations that often rely on credit to finance their operations, have reached levels that make expansion financially impossible. When you're trying to borrow money to rebuild your herd and interest rates are at 20-year highs, the math simply doesn't work. These pressures forced what economists call a liquidation phase in the cattle cycle. This is when ranchers don't just sell surplus cattle, they sell breeding stock. They sell the cows that would produce next year's calves. They sell the genetic foundation of their operations. In some cases, ranchers who had operated for generations, whose families had built cattle operations over decades, made the heartbreaking decision to exit the business entirely. They weren't selling to expand profits, they were selling to survive. This liquidation phase has now lasted for 8 years. We're in year 13 of the current cattle cycle and year 8 of continuous herd contraction. That's extraordinarily long for this type of market cycle. The average cattle cycle typically lasts around 10 years total, with contraction phases lasting maybe 4 or 5 years. This time is different. This time is longer, deeper, and more severe than anything the modern cattle industry has experienced in generations. Now, here's where the story gets interesting from an economic standpoint. When supply contracts dramatically while demand remains steady or even grows, prices don't just increase, they skyrocket. Throughout 2025, the U.S. experienced what can only be described as a beef boom. But this boom is unlike previous cattle cycles because it's driven by genuine scarcity, not speculation or temporary market movements. Cow-calf producers, the ranchers who breed and raise young cattle, experienced their most profitable period in decades. For years, ranching had been a struggle. Margins were thin, competition was fierce. Many ranchers were barely breaking even or operating at a loss. Then, suddenly, everything changed. Calf prices hit record levels. Fed cattle ready for slaughter, passed the $2 per pound mark for the first time in history. When you multiply that by the weight of a finished steer, we're talking about individual animals selling for thousands of dollars more than they would have just a few years ago. This created a fascinating economic paradox. Despite the incredibly tight supply situation, ranchers still weren't rushing to rebuild their herds. Why? Because the same factors that created the supply crisis in the first place, high input costs, persistent drought, elevated interest rates, are still present. A rancher might make excellent money selling their calves right now, but rebuilding their breeding herd would require massive capital investment. They'd need to hold female calves rather than sell them. They'd need to invest in feed, water systems, and infrastructure. They'd need to borrow money at high interest rates to finance that expansion. For many, it makes more sense to capture today's extraordinary prices than to gamble on tomorrow's uncertain profits. Cattle producers are capturing more than 50% of the retail beef dollar right now, a share that would have seemed impossible just 5 years ago. That's a dramatic improvement from the depressed margins that characterized the industry for the previous decade. But here's what's crucial to understand. That improved share for producers has coincided with even more dramatic increases in what consumers are paying at the supermarket. In 2025, consumer beef prices rose approximately 12% year over year. Families planning their weekly grocery budgets suddenly found that a steak that cost $15 was now costing $17 or $18. A package of ground beef that used to cost $4 was now costing closer to $5. These aren't small changes. For families living paycheck to paycheck, these increases represent real money that has to come out of their budget for other essentials. Here's the thing that makes the situation particularly complex. The high prices aren't just benefiting ranchers. They're being concentrated in some unexpected places. The beef industry is extraordinarily consolidated. Just 4 companies, Tyson Foods, JBS, Cargill, and Marfrig National Beef, control 85% of the entire U.S. beef processing industry. That's an astonishing level of concentration. These 4 companies essentially control how much ranchers receive for their cattle and how much consumers pay for their beef. In a market with genuine scarcity, the processors and retailers have enormous power. They can pay ranchers more, which they have to secure adequate supply, but they can pass even larger increases onto consumers. The margins for these large processors are substantial, and they're protected by the sheer dominance of their market position. Smaller competitors simply cannot compete on price or scale. Independent ranchers have no real alternative for selling their cattle. Consumer has no real alternative for buying beef from alternative suppliers. The market is essentially controlled by these 4 massive corporations. This is where things get truly interesting from an investment standpoint. As the cattle crisis has deepened and beef prices have climbed, investors and traders have taken notice. Several investment products have emerged that allow people to profit from livestock price movements without actually owning cattle or having any connection to ranching. This is where things get truly interesting from an investment standpoint. As the cattle crisis has deepened and beef prices have climbed, investors and traders have taken notice. Several investment products have emerged that allow people to profit from livestock price movements without actually owning cattle or having any connection to ranching. The most famous of these is the iPath Series B Bloomberg Livestock Subindex Total Return ETN, which trades under the ticker symbol COW. This is a structured financial product that tracks the movements of live cattle, futures contracts traded on commodity. Throughout 2025 and into 2026, the COW ETN has been one of the best performing investment products tracking agricultural commodities. As cattle prices have soared and the supply crisis has intensified, the value of livestock tracking investments has climbed correspondingly. For investors who position themselves correctly, either by buying livestock ETNs or by trading cattle futures contracts directly, the cattle supply crisis has been extraordinarily profitable. There are other ways to play the cattle market as well. The iShares Global Agriculture Index ETF, which trades under the symbol COW2 on the Toronto Stock Exchange, provides broader agricultural exposure that includes, but is not limited to cattle. There's the Wisdom Tree Live Cattle ETC, which specifically tracks the Bloomberg Live Cattle Subindex. These products represent billions of dollars in assets that investors have allocated to betting on agricultural commodity prices. The beauty of these investment vehicles, from an investor's perspective, is that they allow people to profit from scarcity without any involvement in the actual industry. You don't need to understand ranching. You don't need to own land or manage cattle. You don't need to deal with drought or rising feed costs. But let's circle back to the ranchers, because they're the actual human beings driving the story. The picture for them is decidedly mixed. Yes, cow-calf producers are experiencing their most profitable period in decades. Yes, ranchers who have held onto their land and their breeding stock through the tough years are now making substantial money. But this prosperity masks some genuine hardship and creates difficult decisions about the future. A rancher facing record-high calf prices faces a genuine dilemma. Should they sell their calves now and capture these extraordinary prices? Or should they retain female calves, invest in rebuilding their herd, and try to benefit from high prices for several more years? The rational economic decision for many ranchers is to sell. They can take the money they make today and pay down debt, rebuild operating capital, or simply ensure their operation survives another year. The longer-term strategy of herd rebuilding is a luxury that struggling operations cannot afford. This creates a perverse incentive structure that works against herd rebuilding. Even though high prices are supposed to encourage producers to rebuild their herds, which is how normal cattle cycles work, the underlying economic pressures are pushing in the opposite direction. Many ranchers are in such precarious financial positions that they can't afford to hold back breeding stock, even when prices are high. The geography of the crisis is also important to understand. It's not uniform across the country. Texas, as the nation's largest cattle state, has been hit hard, but different regions within Texas have experienced different levels of impact. Kansas has seen a 7% decline in its beef cow inventory, the largest percentage decline among major cattle states. Montana, Nebraska, Oklahoma, South Dakota, and Missouri have seen smaller percentage declines ranging from 0 to 3%. But these regional variations mask the fact that virtually every major cattle-producing region in the country is experiencing contraction simultaneously. There's no regional escape valve. There's nowhere in America where the cattle herd is actually expanding. This raises important questions about the future. If high prices are supposed to incentivize herd rebuilding, but the economic fundamentals don't support that rebuilding, what happens next? Some economists and industry experts believe we're approaching an inflection point. They think that eventually prices will be high enough and remain high enough that ranchers will take the leap to start retaining more breeding stock and rebuilding their herds. That inflection point might be arriving in 2026 or 2027. When that inflection point arrives, we'll enter the expansion phase of the cattle cycle. Ranchers will start holding back heifers. Breeding stock will be retained rather than sold. Slowly, over several years, the herd will start to grow. Calf crops will increase. Beef supply will gradually become less constrained. And when that happens, prices will eventually decline. Maybe not back to the depressed levels of a few years ago, but definitely down from the stratospheric levels we're seeing today. The timeline for this cycle is important to understand. If herd rebuilding starts in 2026 or 2027, we won't see significantly increased beef supply until 2029, 2030, or beyond. Cattle take time to grow. A calf born in 2026 won't reach market weight until 2027 or 2028. Even if a dramatic herd expansion began tomorrow, it would take years for that to translate into meaningful supply increases. That means consumers should expect high beef prices to persist for several more years, regardless of what happens to the broader economy. There's also the question of international trade. The United States imports beef from other countries, particularly from Brazil and Argentina. As domestic U.S. beef prices have climbed, imports have become relatively more attractive. The U.S. imported a record 4.64 billion pounds of beef in 2024, representing a remarkable 24% increase over the previous year. The Trump administration, seeking to address consumer concerns about high beef prices, has attempted to increase imports even further. In February 2026, the administration quadrupled the amount of beef that can be imported from Argentina at lower tariff rates. However, industry observers note that increased imports might primarily benefit the large beef processors rather than consumers. The processors can source their beef more cheaply from abroad, but they're under no obligation to pass those savings on to consumers. In fact, in a supply-constrained market where domestic beef is scarce and expensive, processors may have little incentive to reduce retail prices. They can continue selling domestic beef at premium prices while using cheaper imported beef for lower-value products. This is another way that the consolidated structure of the beef industry works to benefit large corporations at the expense of consumers. The environmental implications of the cattle herd decline are also worth considering. One of the few silver linings to this cloud is that fewer cattle means fewer greenhouse gas emissions from livestock. Cattle are significant contributors to methane emissions, which are a potent greenhouse gas. A smaller herd means fewer animals producing methane, which means a smaller contribution to climate change from the livestock sector. Some environmental advocates have pointed out that this silver lining shouldn't be ignored, even as we acknowledge the economic hardship caused by the drought and market forces. However, most ranchers are not celebrating this environmental benefit. They're focused on survival and profitability. The prospect of being praised for accidentally reducing their carbon footprint while their livelihoods are being squeezed by drought and market forces would strike most ranchers as cold comfort at best. The government has attempted to intervene in various ways. The USDA has announced a plan to fortify the American beef industry. This includes provisions to expand grazing access on federal lands, potentially providing ranchers with more forage for their animals. The government has also pushed for a product of USA labeling requirements that would only apply to beef from cattle that were born, raised, and slaughtered domestically. The idea behind this policy is to differentiate American beef and support domestic producers against foreign competition. But these interventions are relatively modest compared to the scale of the crisis. They're not going to reverse a 75-year low in herd size. They're not going to bring back the millions of cattle that have been liquidated. They might help at the margins, but they don't address the fundamental issues of drought, high input costs, and the structural problems in the beef supply chain. Looking at specific investment opportunities, for those interested in profiting from the cattle situation, there are a few key areas to consider. Direct cattle futures. Trading through commodity exchanges like the Chicago Mercantile Exchange offers the most direct exposure to price movements, but it's also the most speculative and risky. Futures contracts are leveraged instruments, meaning small price movements can result in large percentage gains or losses. The ETNs and ETFs offer a middle ground. They provide exposure to livestock prices without the extreme leverage of futures, but with more volatility than traditional stocks. The cow ETN, for instance, has seen significant price movements as the cattle supply situation has evolved. An investor who bought livestock tracking products 2 years ago when prices were much lower would have seen substantial gains as prices have climbed. Indirect plays on the cattle situation include beef processing companies and cattle nutrition product manufacturers. Companies like Tyson Foods and other meat processors benefit from the high prices that support their margins. Companies that manufacture cattle, feed, supplements, and other inputs potentially benefit as ranchers maintain or rebuild herds. But these indirect plays come with additional company-specific risk that's not present with direct commodity exposure. The most important thing to understand about all of these investment opportunities is that they represent the transfer of wealth from consumers to various groups in the supply chain. When you invest in cattle-related products and cattle prices go up, you're benefiting from higher prices that consumers have to pay at the supermarket. There's nothing inherently wrong with this. It's simply how markets work. But it's important to recognize what's actually happening. Every dollar that a consumer pays extra for beef ends up somewhere in the supply chain. It goes to ranchers, to processors, to retailers, or to investors betting on commodity prices. The state of cattle production varies significantly across the country, and this has implications for regional economies. Texas, as the nation's largest cattle state, has been hit particularly hard. The state's ranching industry is economically significant, employing hundreds of thousands of people directly and indirectly. When the cattle herd contracts, it has ripple effects throughout rural Texas communities. Feed stores see reduced sales. Veterinarians have fewer animals to treat. Equipment dealers sell fewer tractors and implements. The cattle crisis becomes an economic crisis for entire regions. This is one of the reasons why some in the cattle industry have pushed back against the administration's decision to increase beef imports. They argue that importing beef undermines domestic producers and accelerates the economic decline of rural communities that depend on cattle ranching. They see trade policy as playing into the hands of large processors who can source their beef more cheaply from abroad, rather than supporting domestic producers. The longer-term sustainability of American beef production is genuinely in question. If the current conditions persist, if drought continues, if input costs remain elevated, if interest rates stay high, if consolidation in the beef industry continues, it's possible that American beef production could contract even further. The United States might transition from being a net beef exporter to being more dependent on imports. This would represent a fundamental shift in the nature of American agriculture and would have significant implications for rural economies and food security. Alternatively, if conditions improve, if drought breaks, if feed costs decline, if interest rates fall, if policy supports domestic production, then ranchers might finally begin the long process of rebuilding their herds. But even in an optimistic scenario, it would take years for the herd to return to historically normal levels. The damage of 8 years of contraction doesn't get reversed overnight. The cattle cycle, which has governed American beef production for decades, appears to be reaching an inflection point. We're at a moment where the economic incentives to rebuild herds are finally becoming strong enough that some producers will start to make that commitment, but there's no guarantee that the inflection point has actually been reached. Many ranchers remain skeptical about the durability of current high prices. They remember the 1990s and 2000s, when cattle prices also climbed, only to collapse suddenly, leaving ranchers who had invested in expansion with mountains of debt and no way to service it. This historical memory shapes decision-making. Conservative ranchers who lived through previous boom and bust cycles are reluctant to overcommit to herd expansion based on prices they fear might not last. Only time will tell whether this conservatism is wise caution or a missed opportunity. The story of the 75-year low in the American cattle herd is ultimately a story about winners and losers, about the structural forces that shape agriculture and food production, and about the complex interplay between climate, economics, and policy. The winners are clear. Cow-calf producers who have held on through the tough years are making excellent money now. Large beef processors are maintaining strong margins. Investors who position themselves correctly in livestock-related investments have seen strong returns. Consumers, particularly those on fixed or limited incomes, are the losers, facing higher prices for a staple protein source with no relief in sight. The future trajectory of this crisis will depend on factors that are partially within human control and partially beyond it. Breaking drought and returning to normal rainfall patterns would dramatically change the situation, but that's an environmental factor beyond anyone's control. Policy decisions about tariffs, land access, and industry, consolidation could significantly influence the path forward, and those are within human control. Individual rancher decisions about whether to rebuild their herds will aggregate to determine how quickly the herd grows, and those are personal economic calculations based on individual circumstances. What's certain is that the current situation is unsustainable in the long term. Either the herd will eventually begin to expand, or American beef production will continue its decline with increasing reliance on imports. Either prices will eventually moderate as supply improves, or consumers will continue facing elevated beef prices indefinitely. The cattle cycle, which has operated for generations, is still the governing force shaping this industry. We're in a particularly severe contraction phase, but like all cycles, it will eventually turn. For now, ranchers are capitalizing on extraordinary prices. Investors are profiting from commodity price appreciation. Consumers are paying record prices at the supermarket. And somewhere in the Great Plains and the West, a new generation of ranchers is deciding whether to bet on the cattle industry's future by rebuilding their herds or to exit a business that has become increasingly difficult to sustain. Their collective decisions, multiplied across thousands of ranching operations, will determine the future of American beef. And that future remains genuinely uncertain.